Okay, we're going to have to do this a little bit different than I was planning on doing. I had some technical difficulties last week. My computer crashed and tried to get it back up and going today, and I couldn't get the live stream thing to work, so we're going to do a premiere video this time. And so in the first video, we talked about the history of money, and then we talked a little bit about how money works, the philosophy of money. And so in this one, I wanted to kind of backtrack a little bit on what we've been talking about and talk about the economics of money. As I started thinking about where we were going forward with talking about money, I realized that there are some economic principles and rules and definitions that you may need to know if we're going to talk about how money works, especially with the U.S. dollar. One of the things I want to talk about is how our monetary system works in the U.S. Okay, and so this one is called the economics of money, economic principles that guide how we value and use money. And so we're going to talk about that. And so the first thing you need to understand about economics, and economics, a lot of times people make it overly complicated, but really economics is about human action. Why do people do what they do? What motivates people? How do incentives drive behavior? What trade-offs do people make, and why do they make those trade-offs? How does the availability of goods and services affect consumer behavior? So how does supply and demand work, for instance? And I'm hearkening back with these pictures here to some of the things we talked about in previous videos, just how one person might value a pineapple versus another person, how the barter economy works, and how the behavior of the people that exist in a barter economy, how their actions will be driven by, the prevalence of the goods and services that they're seeking to trade. And then, of course, the Ferrari there. Just to say that some things motivate some people and some things don't. And so economics is really about human action and how people respond to incentives. And people do respond to incentives. That's one of the key tenets of economic theory, is that people respond to incentives. And so economics is a science of human action. It seeks to explain why people do what they do. And one of the things we do know is that people respond to incentives. Now, not everybody responds in a predictable way. Not everybody responds to the same incentives, things like that. But in general, we can see tendencies of people to respond to incentives. And so if you want more of something, you reward it. If you want to encourage a behavior, you reward that behavior. If you're a company and you want somebody to work for you, you pay them, right? I mean, there are not many people that are walking around wanting to work for a company without pay. You have to incentivize people to be willing to come and work for you. And so people will respond to positive incentives, but not just positive incentives, negative incentives. So on the flip side, if you want to discourage a behavior, you need to punish that behavior. So if you speed regularly, if you have a lead foot, at some point you will get a ticket and your insurance company will increase your insurance costs. You'll have to pay the ticket. There's some negative incentives to speed. And so people will respond to incentives, whether positive or negative. Another idea that economics tries to help people understand, and a basic tenet, is that there are always trade-offs, right? There are always trade-offs. And there are always opportunity costs, and those kind of are the two sides of the same coin. So because some actions are rewarded and some are punished or not rewarded, people are constantly making trade-offs. Okay, and so the thought experiment in this point that I want to do is, will I buy a Coke every day, or will I buy a video game in a couple of months? So that's a trade-off that you would have to make sometimes. Like if as you grow up, as you begin to earn money, you'll have to make trade-offs. You will buy this, you won't buy that. Almost nobody is in a situation where they don't have to make trade-offs, no matter how successful you are. Now the trade-offs become less important, like, am I going to buy this yacht or am I going to buy the Ferrari? Well, you don't need either one of those things, but most people don't have to think about that. Most people have to think about more practical trade-offs. Am I going to eat today, or am I, like at a fancy restaurant, or am I going to buy the video game that I want, or am I going to go out to eat next week? So the opportunity costs then are the relevant costs for making these decisions. So to go back to my example, the cost of me buying a Coke every day means that I won't be able to buy a video game in a couple of months. So the opportunity cost for me buying a Coke every day is that I won't get to buy the video game next month or in a couple months. depending on how much the video game costs, of course. And so there are trade-offs that people make every day with their money, and there are opportunity costs, which are the cost of doing the things that you choose to do instead of the other options, the cost among the different options that you have. Okay, and then just to kind of cram a whole bunch of economic definitions into one slide before I apply this to money real quickly, you have the ideas of supply and demand, competition, substitutes, and prices. Okay, so in addition to opportunity costs, to understand how people respond, you have to know how goods and services are allocated in a free market, which is the interplay between demand and supply. Okay, and demand is infinite. Everybody wants a yacht. Everybody wants, a nice car. I would like a nice car, but I don't want to pay all the costs that are associated with that. So that makes me not want the car, right? But if really nice cars were plentiful, they didn't cost very much, there was very low barrier to buy one, demand would be, people would want that. And so our demands are infinite. What's finite, though, is the supply. The supply of the goods that we want, the supply of the money that we have to be able to buy those goods. And so it kind of harkens back to that idea of scarcity that I talked about in the last video. So the supply is always going to be scarce because there's nothing infinite. There's no infinite supply of anything, any physical thing in the universe that we know of. And so there will always be constrictions on the supply of goods and services to some degree. Okay, so not only are there the way we allocate resources, it's not just determined by supply and demand, it's also determined by competition. So if I make something that is a good or a service, and somebody else comes along and does a better job than me, then they may take away some of the demand for my product or my service that I offer. And so in a free market, there will be competition. And so in free markets, you will always have the risk of competition or better alternatives. We'll type in there. And so, and not only do you have competition, you also have substitutes. Okay? And so competition and substitutes, sometimes they're the same. There's a little bit of overlap, but there's also a little bit of a difference. Because you might have let's say you want a pair of shoes. Well, a competitive shoe, you'd have Nike versus Reebok, right? Well, what if you don't have to wear shoes? A substitute would be a pair of flip-flops. If a pair of flip-flops will work for you, that's could be in certain circumstances a good substitute for shoes, right? And so you use this instead of that. And you might say, look at the your Nike Air Jordans. They cost $250 or whatever, and think, I think I'd rather buy a $3 pair of sandals at Walmart. It's not exactly the same kind of thing. It's still something you put on your foot, but it's a substitute good for your Air Jordans that you might want to get. And so there's competition, there are substitutes. There are always additional options available in a free market. And think about how the supply and the demand works with that. If the supply of a particular good is low and the demand is very high for it, then there may be opportunities for people to come into a market and offer a substitute good that may be not quite as good, but maybe it's half the price of the main good that people want. And so there are always substitutes, there are always additional options available in a free market. Okay, and then I've got a chart, and you can see there's the chart of demand and supply. And it's a little bit complicated, but basically, as demand increases, okay, and if the supply stays the same and demand increases, what's the price going to do? The price is going to go up, right? As the supply increases, though, and if demand stays the same or goes down, that means the price is going to decrease, right? And so what we talk about when we talk about price is the point at which goods trade, between people. You have a willing buyer and a willing seller, and the willing buyer is willing to pay X dollars for your widget. Say it's $10. If most people are willing to pay $10 for your widget or your good that you are selling that you've manufactured, then that is the determined market price of the good. And so there's that point, that what we call the equilibrium price there. So it's where the price and the quantity, the available supply, and the price, the amount of money that the seller is willing to take for it, and the amount of money that the potential buyer is willing to pay for it, that's the price. That's what the price is. And prices are really magical things because it takes a ton of information and boils it down to one number. How much does a Coke cost? 50 cents, maybe $1 in certain situations, sometimes more than that. If you're at an airport, it might be $2.50. But it's the price at which both the seller and the buyer come to an agreement. And they say, yes, I'm willing to buy, I'm willing to pay this for it. The seller's willing to sell it for this. That's the price. And it works on all kinds of things, not just Cokes and cars, but stocks. It also works with money, okay? And so, because the money part of that is half of the equation. And we're going to talk more about that in just a minute. But so basically, with the pricing mechanism that exists in free markets, you have win-win situations where a willing buyer willingly departs with their money for the good of the seller, for the good that the seller is selling, and both parties are better off. Because I wanted to spend that $10 on the widget that you sold. You wanted to take the $10 on the widget that you sold me. We both agree. I'm getting more than $10 in value for the $10 that I spent on your widget that you created. And I'm just using widget as a general term for any kind of good that somebody might have. It could be a video game, it could be a car, it could be a baseball card, it could be a toy, anything really is what it could be. But at the point where a transaction is made, both parties are better off, okay? And so you might be asking yourself, what does this have to do with money? I thought you were going to talk about money. Well, the economics of goods and services, supply and demand, trade-offs, competition, and substitutes, just as goods and services are subject to those laws and those rules and those aspects of how economics works, so is money, right? Money is yet another kind of a good, right? It's something that we use to transmit value between each other, right? And so think about that if you apply supply and demand to money. What if there's a huge supply of money? What happens then? If let's say everybody has $100 in their checking account, and the government came and deposited another $100 in everybody's checking account, has the government created any new wealth by doing that? I want you to think about that for a minute. What if the government doubled the amount of money that everybody had in their checking account? Would they have created any new wealth? Think about it. So before, let's say you got a really simple economy, everybody's got $100, we're starting from scratch here, everybody's got $100 in their checking account. And there are a few goods available. Let's say everybody does pretty much everything themselves, fends for themselves, but there's milk, and there are eggs, and there's bread. Okay, those are the three goods that are available, and they all cost $1 a piece. $1 for a gallon of milk, $1 for a dozen eggs, $1 for a loaf of bread. Okay, and that's what the market price is currently. Well, if you double the monetary supply, what's going to happen to the cost of those goods? All things equal. I mean, there could be things that could change that. But if you just double the money supply, have you doubled the amount of milk? Have you doubled the amount of eggs? Have you doubled the amount of bread? No, you haven't done any of those things. All you've done is doubled the amount of money that's out there. And so what's going to happen to prices if that's all you do, is double the amount of money that's out there? Prices go up, right? So if everything was $1 and now everybody's got double the amount of money they had, probably everything's going to go up to around $2 a piece. Again, there's some assumptions in there. Like if certain egg producers became more efficient and they were able to still sell their eggs for $1 and still make money, that would work. But if nothing else changes except the amount of money that's out there, then you would expect that prices would double if the monetary base doubles. Okay? So another way of saying that is money that is really easy to get and whose supply is virtually unlimited is subject to devaluation or inflation. And again, this is just simple supply and demand. As the supply of something goes up, and if the demand doesn't have a requisite increase to go along with that, the value of that thing is not going to go up. And in fact, it will go down if the supply goes up and the demand stays the same. And so I just want to point this out to say that, because there's a lot of stuff going on, and I've talked about, kind of hinted at some of the things we're going to talk about in the future about monetary policy. But money is indeed subject to the same economic laws that other goods and services are subject to. Now, there are some things that can counteract increasing the money supply, okay? And we'll talk more about these in later videos. But the only way really that you can increase the money supply without causing the cost of the goods and services that are available in an economy to go up is to increase the number of people or the communities that use that monetary base, okay? And so one of the things that has protected the United States, for instance, from a lot of the inflation that we would have seen otherwise had there only been just an increase in the monetary base, is that people from other countries use the dollars as well, okay? And that's going to be a really important concept to think about in the future, is the network effect, right? And so one of the values of money is that so many people take it and so many people use it and so many people value it. They ascribe value to the dollar, and that's one of the things that gives the value to $2. And if you can increase the number of people that are willing to use dollars as their means of as their currency, as their medium of exchange, then you can keep the value, relative value high relative to goods and services. So, but money is subject to trade-offs, okay? It's subject to competition and substitutes. So you have to ask yourself a question. You've got money, if you've got saved up money that you have saved for a rainy day, you could, if you wanted to, take that money and buy, you could buy gold with it, or you could buy silver, or you could buy, tanker trucks full of oil with the money that you save, and hold that instead of holding dollars, right? I mean, you could hold other commodities instead of just dollars. Gold, silver, crypto, all those things, you could instead of holding your money or your cash in those things, you could actually buy something with it and hold that instead of the cash and use that as a reserve. I just want to say and point to the fact that money, just like every other good and service that we have, is subject to the laws of economics. And just because the dollar is something that is used worldwide and has a very good reputation and people trust it, and there's a lot of trust in our community in the United States for the dollar, doesn't mean it will always be that way. And we have to realize that at some point, as you print more and more of it, as you increase the monetary base without increasing the goods and services that are being produced in an economy, you're not creating wealth. You're not creating, the goods and services that actually have value. And so I just wanted to point that out and maybe give you some categories for understanding economics so that we can apply that knowledge to money. And so if you have questions, this is a little different. Again, this is kind of a premiere video. And so please, if you have questions, put them in the comments below. I will try to get to them as quickly as I can and give you guys some answers and interact with you as you watch the video. So I hope this has been helpful, useful. I think in the next video we're probably going to start talking about how U.S. monetary policy works and how the dollar works and how, where it came from a little bit. I mean, we've kind of already talked about the history of it a little bit, but talk about how it works and how the Fed works and how the Treasury works and all that. I'm going to give you a simple explanation for how that works. So I hope this has been helpful. Please like, share, and subscribe to the video. Thanks for checking in with us and watching along with everybody. So please subscribe to CFO Dad, and I'll see you guys in the next video. Thanks.